Right now, the market is a tale of two tapes. Let's break down the framework for how to position over the next 1 to 3 months.
Okay, so you've got this massive AI infrastructure build-out. We're talking $75 billion in debt issued by big tech in just 2 months to build data centers. But at the exact same time, you've got the consumer sector flashing some serious warning signs. The retail ETF XRT is down 6% in the last month alone. That's the divergence right there.
So the core thesis is simple. We're in a rolling recession, and that's creating what we call a K-shaped market. Clear winners and clear losers. In this explainer, we're going to unpack the exact levels and scenarios you need to be watching to navigate this split.
All right, let's dig into it. What are the conflicting data points actually driving this tape?
The contrast is pretty stark when you lay it out. You see the AI CapEx boom, you see that roughly 83% of companies are beating Q3 expectations, and on the surface that looks great. But then you look under the hood. You see reports from McDonald's, from Coca-Cola, that the consumer is pulling back on price. XRT is down 6%. And get this, 32 out of 37 consumer staple stocks are in the red. Even the safe stuff is struggling. Now, what's really interesting here is that consumer sentiment is hitting bear market lows. That could be a huge contrarian signal.
Okay, so with that split backdrop, let's turn to the calendar. What are the macro risks on the horizon that could really inject some volatility here?
We've got a few key risks converging in the next 30 to 60 days. First, the government shutdown is now on day 37. That's impacting the FAA, it's halting SEC filings, basically gumming up the works. Then you have a major wild card, a Supreme Court ruling on presidential tariff authority. That's a binary event. And of course, the next CPI and retail sales data are going to be critical reads. And for you chart watchers, we've had a cluster of 4 Hindenburg Omens recently. Love it or hate it, that indicator points to a high probability of market chop ahead.
And you can see this K-shaped dynamic play out perfectly when you break it down by sector.
I mean, look at this. The chart says it all. You've got tech and industrials up here, and consumer staples way down here. The gap is widening, and it's widening fast. It's a clear rotation.
So you have to be precise. The winners, AI infrastructure, think NVIDIA, Microsoft, and the industrials supporting the build-out. I mean, we're seeing electricians in Texas pulling down $240 to wire these data centers. That's where the money is. The losers? Anything tied to the low-income consumer, so your McDonald's, your retail ETFs. Even dividend stocks are getting hit as capital rotates. And look at private credit. OWL is down 14% in 6 months.
This quote here from a McDonald's earnings analysis nails it. This is a K-shaped recovery. It's not that everyone is pulling back. High-income consumers are still spending. It's the low to middle-income consumer that's getting squeezed. That's why just looking at the S&P 500 can be so misleading right now. The weakness is concentrated.
All right, quick pause for our standard disclaimer. This content is for educational purposes only. We're just pulling together public info to help you make sense of things. You have to do your own research. This is not financial advice. And hey, if you're getting value out of this, a quick like and subscribe goes a long way. It tells the algorithm we're doing something right and helps the channel grow. I really appreciate the support.
Okay, so let's put this all together. How do we turn this into a practical framework with hard levels?
Right now, there is one line in the sand that matters more than anything else, the 50-day moving average. On the QQQ, on the S&P 500, this is the key support level, period.
So here's how I'm thinking about it, in 3 scenarios. My base case, call it 60% probability, is that we just chop around, the divergence continues, AI strength versus consumer weakness, and that 50-day moving average holds as support. The posture there is cautiously long tech, but hedged. Now the bull case, maybe 25% chance. The AI boom just barrels through everything. Dip buyers defend, and the 50 DMA is confirmed as a hard floor. That's where you add to tech exposure on dips. And the bear case, 15%. The consumer weakness finally spills over, we get a sustained break of the 50 DMA, maybe some forced liquidation, and that's your signal to reduce delta and raise cash.
All right, let's talk actionable setups. Here are 3 potential option structures to express these views, all with defined risk.
And before we do, the mandatory options risk warning. Trading options carry substantial risk. It is not for everyone. You can lose more than your initial premium. Always manage your position size and use stop discipline.
Okay, setup 1, bearish on the low-income consumer. The tickers here would be McDonald's, MCD, or the retail ETF XRT. The thesis is just a continuation of the spending pullback we're seeing. For a defined risk way to play this, you can look at a put-debit spread.
Your risk is capped at what you pay for the spread, and your invalidation level is clear, a sustained close back above the recent highs.
Thesis 2. Bullish on tech dips. This targets the QQQ. The idea here is that the buy the dip mentality is still very much alive, especially at key technical levels. The structure? You could sell a cash-secured put at or just below that 50-day moving average. The rationale is twofold. Either the level holds and you collect the premium, or it breaks and you get assigned the shares at a level you already wanted to buy. The invalidation is a confirmed break and close below that 50 DMA.
And for the third idea, this one's a pure volatility play. It's tied to that Supreme Court tariff ruling. For companies like Mattel or Estee Lauder, this is a binary event. The stock could gap up or down in a big way. So the structure here is a long strangle. You're not betting on direction, you're betting on a big move, any big move. The risk, and it's a big one, is theta decay and IV crush. If the move isn't big enough or if it takes too long, you lose. After the news drops, that implied volatility is going to get crushed, so you have to be right on the magnitude of the move.
So it all boils down to this question. The AI infrastructure boom is real. The consumer slowdown is real. Which force breaks first? That's the tension that's going to define this market.
And that's the setup. Remember, this is not trading advice. This is just a market update to keep you informed. Markets carry risk. Trade your plan, manage your downside, and verify everything.